Hello and welcome to this episode of our educational series. I'm Terry Cook, Managing Principal and founder of Parcion Private Wealth. And nice of you to be able to join us. I'm excited about our latest installment in our educational series. At Parcion Private Wealth, we founded the firm in order to work with business owners, entrepreneurs, and their families in optimizing wealth events, navigating the complexities of that wealth, and supporting their legacies. And part of that, and there's nothing more important to the families that we serve than the next generation, and educating and informing and supporting. And so we started these series of events for those next generations, as an educational platform. And I'm glad to say that they've kind of grown to where now whoever finds them useful have been tuning in. So hopefully, whether you're 15 or 75, you get something from today, and I think you will with the content that we have here. So alternative investments alternatives is a very broad category, and lots of, obviously it brings into the context of lots of options, but we're going to talk today about how we view, I'm going to bring in our Chief Investment Officer, John D. Carvalho, here in a second, to talk about how we at Parcion view the space and how we utilize it to construct portfolios and support our clients' goals. And once he does that, then we've got three experts in different areas of the alternative investment space that I'll introduce, and that will kind of open up a panel discussion to talk about their individual areas, and that's digital currencies or cryptocurrencies, real estate, and venture capital. So excited about the content, and I think to get it going, let me see. Actually, I'm going to share here and just do a little bit of housekeeping before I jump too far into this. On your screen, those of you that have participated in these Zoom webinars before might be familiar, there's a chat function. And if you want to ask a question, just go ahead and type it in there. We'll get to as many questions as we can. And if we don't get to your question, we'll follow up and make sure it gets answered. But just wanted to point that out. So I think with that, I will turn it over to John to help explain how we approach alternative investments. Mute, John. You're just on mute, John. All right.
My apologies. The mute button just sort of disappeared on me, and my use of technology here got me a little worried there for a second. So thanks for joining us. Really appreciate it. We are, and thanks again. I wanted to broaden the discussion on the variety of alternative investments that are available to you. As Terry mentioned, there's a number of different categories. So a lot of us are familiar with real estate and private equity and venture. And then we had another section there on sort of esoteric types of investments. And this is where the Bitcoin area that we sort of slot that investment in that space. Hedge funds is also a very broad definition within the alternative space. And we're not going to discuss some of the more high octane types of hedge funds. We tend to invest in more conservative hedge funds that dampen volatility for the overall portfolio. And that brings us to the next slide here, which discusses alternative investments and how we use them in our portfolio construction. We look at alternatives as those that will help dampen overall volatility, or in other words, reduce the amplitude between gains and losses. Because if you don't lose as much on the downside when we have market events, then you don't have to gain as much on the upside. So a simple illustration would be if you had $100 and you lost 50% of that, you're down to $50, you have to make 100% just to get back to even. Whereas if you lost $25, 25%, you only have to make 33% to get back to even. So you cut the loss in half and you reduce what you have to earn back by more than half, 67%. So the performance for alternatives, generally, in light of that, it should not move in tandem with stocks or bonds. They should move independently and not be influenced by those two categories. Thus, the returns for alternatives, we derive the return from different risk sources. So in any type of investment, you have to take on some sort of risk to earn that return. We want to make sure that the source of those risks for alternatives is differentiated from stocks and bonds. So for example, stocks are really affected by economic risk. So are we growing, expanding, or are we contracting? And bonds are really influenced by credit risk, meaning like how viable is this company and likely they are to pay on their debt over the long term. And then duration risk is really interest rate risk. If interest rates go up, then the value of your bonds go down. If interest rates go down, then the value of bonds go up. So those are the risks that we traditionally, those are the risks that drive the returns for those two asset classes. So the best way I can sort of illustrate this is to make an analogy, which is to say if your portfolio return was the equivalent of the energy production as a result of sourcing from different things, then we can look at this way and say that you can derive energy from several different sources. You can get it from solar power, from fossil fuels, from hydroelectric, wind, nuclear, several different sources, but they all add to the return. And the thing about that is, if it's sunny outside, it could be windy or it might not be. They're independent of one another. If fossil fuel prices rise too high, we can substitute maybe some other sources like hydroelectric or nuclear power to derive the energy that we need. When we talk about alternative asset classes not moving in tandem with stocks and bonds, this chart sort of illustrates that, if you will. So one would be a perfect correlation. That means it moves exactly in tandem with one another to two asset classes. -1 would mean that the asset classes move in complete opposite direction of one another. So as one goes up, the other one goes down by this proportionate amount. So what you'll see here on this chart is if you look at the first column, you'll see as we go down the rows, stocks are perfectly correlated to one another, as that would make sense. If you look at stocks and bonds, they're not correlated whatsoever. I mean, that's basically zero. It's very close to zero, so they're not really correlated to one another. Commodities, which we consider an alternative, is 50% correlated to stocks. And real estate is 76%. Managed futures is another alternative strategy, very low correlation. The reason why the real estate may look higher in correlation is because we had to use an index which is made up of real estate companies, not the actual real estate itself that you would be investing in. So that's why that correlation looks high. But generally speaking, when you invest in direct real estate, the correlation to stocks is much lower. The same could be said for the bond side. If you go to the second column, you'll notice that real estate 25% correlated to bonds, probably much lower in the direct real estate section of the portfolio. So just to talk about some of the pros and the cons of these alternatives. The pro is it does dampen volatility. So you reduce the variation among the returns that you're earning. The con to that is that these strategies usually require higher fees and they do have higher expenses. So to offset that, they pass that along to the investors, and they usually are higher than public securities that you can purchase, like on the stock market exchange. The pro for this is on alternatives is that they do enhance the profile, the risk reward profile. Like we said, if you're not, what we're trying to do with the alternatives is maximize the return with the least amount of risk, just like any other type of investment. So as we add an alternative to a standard portfolio, that improves the risk reward profile. So we think we're getting more return for the level of risk that we're taking on by adding alternatives to the portfolio. Now, the offset to this is like in the current market environment, stocks will outperform alternatives, and they could for an extended period of time like they have. But that's understandable because what we have the alternative in the portfolio is to dampen the volatility or market downturns that are really unexpected. So if we were to add them when we saw this volatility taking place, somebody made the analogy to me that it would like be trying to buy home insurance while the house is on fire. The cost would just be too prohibitive, and your portfolio's already absorbed that loss. So that's why we have them in the portfolio. It also offers us access to unique strategies that are not readily available, such as venture capital, for example. You can't really buy venture capital on an exchange or invest in that in a liquid type format. These are investments into startup companies that have a great deal of potential to disrupt the market or fill a need that the marketplace is looking for. For this reason, because you're investing in these companies over the long run, there's a lack of liquidity, meaning that if you wanted to pull your money out, you're going to affect other investors within that strategy. So there is a lockup period where you wouldn't have access to that, but that we try to take advantage of what's called an illiquidity premium. That means that we are going to earn money for having the funds be locked up for a period of time. Now, alternatives, again, going down the pro list, you'll see that it does require these longer term investment horizons. So the pro here is that it turns your attention away from looking at the day-to-day market fluctuations. Some of these investments don't get valued, but on a quarterly basis. They're not valued every day. Some may be on a semi-annual basis as well. Now, the thing about these types of investments, the offset, the con about it, is that there's little to no regulation over these types of investments. They're private, so it requires a great deal of due diligence to make sure that you're investing with professionals and the terms of those contracts are beneficial or favorable to the investor and don't advantage the general partner or somebody that's offering these investments to the public. Again, these investments are not just available to anybody. You need to qualify for them on an accredited status. And there's parameters around that that we can explain at a later date, or if anyone has any questions around that. The second to last pro that we've got listed there is it's better access to higher growth potential investments. Venture capital is that type of investment. It has the potential to really earn a lot of money. So for example, Amazon, when they first came out, it was a venture and people had to take a risk on investing in Amazon. It was something that wasn't common. They were going to sell goods, and it was really books at first online. And if you believed in that model and you invested then you made a significant, and I mean a significant amount of cash on that investment there. So there is growth potential. However, it does come with risk. So just keep in mind that you have to sort of make these investments over a number of companies because there's things that can occur that will unexpectedly affect the value of those investments. Now, reporting, this is the other offset to it, is where we said that you don't have to look at it day to day. That's because the reporting, like I said, the valuations don't come in all the time. For us as a registered investment advisor, it makes reporting a little bit more challenging because you don't have that timeliness of day-to-day marking of the value. Again, the last item on the pro list here is that if you invest early in these types of investments, you can receive beneficial terms, more advantageous because you were willing to take the risk earlier on than maybe investors that come later. So they're going to try to provide an incentive for those that invest earlier on. The last thing on the cons list is that it does require a little bit more complicated sort of tax return preparation. So a lot of these investments come with K-1 statements, different than the standard 1099 that requires more in-depth reporting on a tax basis. So from that, I'm just going to give you a brief overview of the categories that we're going to be talking about, and then I'll turn it back over to Terry. So cryptocurrency, that's one that Terry alluded to, and we have an expert here to talk about this. It's been in the news a lot this year. And I don't think that the general public has a really good hold of what cryptocurrency is. Generally speaking, it's a digital currency that we can use to buy goods and services. And the thing about crypto is it's very, in terms of the security level, it is quite secure because it uses blockchain technology, which basically verifies that those transactions are taking place on a real-time basis. Cryptos are very volatile. I think most of us have seen the valuation of Bitcoin run up to 50,000, come all the way back down to 30,000, and then run back up. So that's volatility that you wouldn't experience normally in the marketplace. However, by assuming that volatility, there is potential to earn outsized gains. But remember, this market is, there's a lot of speculation going on in cryptocurrencies right now from people trying to capitalize on those wide price movements. There is some uncertainty with crypto about whether it's going to be a viable substitute for currencies, and whether that can work. There's a few things that go on with traditional currencies that don't apply to crypto, which means you cannot contract or expand the supply other than what the programming has done. And in traditional currencies, the governments expand and contract money supply to support growth or curtail an overheating economy. The next thing we're going to talk about is real estate, and specifically qualified opportunity zones. So there's the definition right there. A qualified opportunity zone is organized as a corporation or partnership, but they invest at least 90% of their assets in what is called a qualified opportunity zone. These are areas that the government has designated as areas that they'd like to develop, that they're going to give you incentives to invest there to help develop these areas for the better of all society. So why should the individual investor put money towards these types of investments? Well, aside from the altruistic nature of it, it does provide you a tax incentive. So we're going to develop in these economically distressed communities, and the government's going to give you a tax incentive for doing that. And I'll explain what that is on a high level overview. So the main thing is that you have the opportunity to defer capital gains and then potentially reduce your tax burden on those capital gains. Here's a diagram that kind of explains that. So the key benefits, again, deferral of capital gains. You get a reduction potentially in the capital gains. So if we follow along on the timeline, you'll see what happens. We will try to recognize capital gains, or if you did have a capital gain that occurred in 2020, we have 180 days to invest that into a qualified opportunity zone. Within that 180 days, what happens is you get to defer those gains out into the future. After year 5 of this investment, the government says we're going to forgive 10% of that original capital gain that you realized. So you're getting a break. You're getting 10% of your money that you made tax-free at that point. In April 2028, that's when the taxes will be due on those original capital gains that you deferred. Now, that will have to be paid up front, but that's minus that 10% of the gain that you had, the government forgave, if you will. Now, at the end of year 10, which these terms usually run till, all those capital gains should be eliminated by the gains that you've made on the underlying real estate investment within that qualified opportunity zone. In addition to that, all the gains that you do make on the qualified opportunity zone are tax-free. That means whatever that's been earned, you don't have to pay taxes on that, whatever's been derived from your development investment. The last topic we're going to talk about is venture capital. I alluded to that. Here's the specific definition. It really provides financing to startup companies, small businesses with these long-term growth potentials, like I mentioned earlier. These funds, like our expert's going to talk about, Cameron, what they do is they pool funds together. They have an opportunity set of companies that they'd like to invest in, and they fund these companies with terms that are going to be beneficial to both parties. In addition to that, a good venture capitalist will provide consultation, or they'll provide their expertise on how to get that company to the next level. So with that, hopefully you got a broad overview of these three asset classes within the overall alternatives umbrella. And with that, I'll turn that back over to Terry.
Unmute myself there. Thanks, John. That's appreciative, and the overall discussion on how we view alternative investments. Let me go back because I had the slides a little out of order, and introduce our panel here. And I appreciate these gentlemen joining us. And we're going to kind of switch it up now, as opposed to just kind of going through those areas one by one. We're going to have kind of a panel discussion, and including hopefully some of your questions out there. But first, let me introduce the panel that we've brought in here, and I appreciate these gentlemen joining us. We'll start with Zach Forman. Zach serves as Senior Vice President, Head of Fund Relations at Griffin Capital Securities. In this role, Zach oversees the selling group relationships across all investments, working directly with the portfolio management teams to act as an information conduit, both within Griffin Capital and to their external partners like Parcion Private Wealth. Zach has over 16 years of experience in the financial services industry. Prior to joining Griffin Capital, he was head of capital markets for RJL Capital Management. Mr. Forman received his Bachelor of Arts degree from the University of Arizona. So we've got a wildcat in our midst here. And I'll switch it over to Chris. Chris is with Fidelity Digital Assets. He's a senior manager in business development for Fidelity Digital Assets, which provides enterprise-grade digital asset solutions for institutional investors. Chris works closely with institutions such as ours and other family offices, hedge funds, corporations, and endowments on their digital asset management strategies. So perfect person to have here talking about crypto with us. So prior to joining Fidelity Digital Assets, Chris served for 3 years as senior regional investment consultant at Fidelity Institutional Asset Management, holds a Bachelor of Science in Marketing from Providence College. And last but not least, Cameron Borumand. Cameron is a founding general partner of Fuse, where he focuses on early stage investments in horizontal and vertical intelligent application software. Previously, Cameron was a key principal at Ignition Partners, a leading enterprise software focused venture capital firm. And at Ignition, Cameron played a key role in sourcing, identifying, and supporting new investments, including carbon robotics. Fascinating. Prior to Ignition, he was co-founder of Curious Capital and also spent some time in the Bay Area as a technology industry investment banker at Vaquero Capital. He holds a BS degree in business administration finance from the Foster School of Business at the University of Washington. So how'd I do, gentlemen? That good. I appreciate you all joining us. And now as I skip around here, and you know what, I'm just going to stop sharing here just so we can all kind of get back together here. And you know what, I'm going to kind of mix this up. But I think, Chris, I'll start with you if that's all right. And just start off with kind of a general question. You know, what makes kind of the digital asset industry or space an interesting and valuable investment to investors right now, in your opinion? So Chris, I want to start with you.
Sure. Yeah. And thank you, Terry, obviously, and team for having us. Appreciate the exposure, and I think the platform to talk about a space that's pretty volatile, but pretty in the news. So hopefully people are, you know, whether it's the first or second or third time looking at the space, hopefully I can add a couple of insights today. And so I think, you know, when you think about the space as a whole, I think John actually made a comment that resonates with me, where we talk about government control of currencies. And I think that's where over the past year or so, people have started to really experience that on a day-to-day basis. And so it's not to say that government's controlling currencies is a bad thing by any means, but it kind of enters a level of trust. And so you're asking central bankers essentially to act responsibly around monetary and fiscal policy. And so if we take a little bit of a step back as to where Bitcoin and other assets kind of entered the market, really we kind of see this deep dive that a lot of people go through into what is money. And so if you go back, you know, not throughout all of eternity. But if you go back about 100 years, you look at Bretton Woods, that was basically in 1944 where gold and the dollar became very important for the world. And so what happened was essentially the dollar was going to be pegged to gold. You could at that time still exchange dollars from the US government for pieces of gold or gold bars. Then fast forward a bit, 1971 comes around. Again, Bretton Woods, it's basically 50 years almost to the day. Basically, Richard Nixon pulled the dollar off of the gold standard. And you almost have this decoupling where you could still own gold, but you could no longer exchange US dollars for gold bars. And so what happened there, it's a pretty important moment in time where essentially people said, now we have to put full faith and trust in the US government. And so what this does is, I think any of us on this call for the most part have experienced a pretty, a lack of volatile currency in our lifetime. But if you look across the globe, unfortunately, it's not the case. And so if you think of the population of the world, that encompasses a lot more than just US citizens. So you think of Greece or Zimbabwe or Venezuela, they've experienced over the last couple of decades, extreme levels of hyperinflation. And so that kind of enters what I would consider, the first iteration, the first layer of digital assets. And so that's where, in my role, we talk about this day to day. We definitely, obviously, I took a personal interest and moved my career into the space because there was a strong belief. And so entered Bitcoin in call it 2008. And so it was essentially created by a pseudonymous group called Satoshi Nakamoto at the time. And I think it's important to note this was not by any means the first attempt at a digital asset or a digitally native asset that represents value on the internet. There was things like DigiCash and eGold. And the goal was, how do we, like the internet, transfer value, across the rails in a global way? And so this was really the introduction it's an 8-page white paper. I would, encourage anybody that hasn't read it before. It's pretty quick read. It's not too in depth, but essentially it lays out a peer-to-peer electronic cash system. And what this is doing, it's really allowing investors to then take a step back and say, this is now a new option. This could be a growth for a financial network. And so I would say this is where enter the opportunity to kind of answer Terry's original question. It's what is the opportunity of investing in digital assets? What does that represent? I look at it this way, where you saw the internet allow the ability over the last, 3 decades or so to transfer information near seamlessly in a matter of seconds. We went from sending hard physical mail to actually being able to transfer emails and texts in a matter of seconds. Groundbreaking. It's the applications that have come out of that. It's absolutely incredible. And we didn't have that ability with value, so this was what Bitcoin represents. And so I would look at it this way, where you have a very transparent monetary system with a fixed supply, very transparent supply schedule, but also the ability to do this in a global nature with no government control. So it creates optionality. And then from an investment perspective, obviously the upside is important. This is where volatility comes in. But I would say you have the opportunity in some sense to invest in a protocol level of all of the growth that could come out of this, new digital financial system. So I'd make an analogous kind of as a last point, imagine if you could invest in the internet protocol. So TCP IP in the very early days, you're not picking a company, but then you benefit from all the applications, the Google, the Amazon, et cetera, that was built on top of that. So I think that's what Bitcoin represents today. We're very early stages, about 12 years into this, and I'll maybe pass it back to Terry from here, but that's kind of the opportunity I see in the market right now.
Yeah, very, very early stages. And then we can get into the valuation discussion, which is a lot harder. And it's a fascinating kind of supply and demand, obviously raw calculation. So let's move over to venture capital. And Cameron, maybe you can kind of talk to us a little bit about the space and what you see are some of the compelling reasons why folks should be thinking about the space for the longer term.
Yeah, absolutely. First off, big thank you to Terry and John and the entire Parcion team for making this happen. I can talk a lot about this stuff for a while. I've dedicated my life to it, and venture capital is a odd, and very interesting space in my opinion. Really, what we do at a high level is as John alluded to earlier, we invest in promising early stage private companies that we think have the potential to transform industries and change the world. We typically invest, at our fund, for example, at the seed and Series A stage typically invest $4, $5, $6 million and own about 20% of these businesses. We'll take a board position where, as John mentioned, we're helping the CEO and the management teams, with strategy, with talent, and with customers. And the reason that the venture capital industry exists, and it was started in the early 1970s, is that you had groups of entrepreneurs that had large, big, hairy, audacious ideas and needed capital to go build. And these aren't traditional businesses in the sense that a lot of times where they start a business and they immediately start making money. So that was why the need for venture capital came into existence. Many of the companies that venture capitalists invest in don't make money in terms of EBITDA or profit for a number of years. And really the name of the game of venture capital is growth. And so the industry was really founded in the 1970s and has gone through three waves. The first wave was with the origins of computing with Apple and Microsoft. That's when you started to see the initial venture capital industry and investment starting to take place. And then it was the early 2000s and 90s with the boom of the internet, where you had companies like Amazon and eBay and PayPal come into existence. And lastly, we're really in the third wave of what I'd call the cloud computing revolution. And we'll talk a little bit about what that is later. But really, it's enabled companies to be started at a much faster rate. And so you have way more founders spinning out of technology companies to go start businesses today. And it's incredible what founders will come up with. And the crypto space, as Christopher was saying, is grabbing the attention of a lot of venture capital dollars right now as well. And the reason that this is an exciting industry in my eyes is these companies have the opportunity to transform the way that we work, whether it's and operate, whether it's how we work with DocuSign, Slack, Salesforce, or how we communicate right now with Zoom that was supported with venture capital money, or Facebook or LinkedIn, or how we have fun and learn with Spotify, Airbnb, and YouTube. These are companies that would have been tough to get off the ground given the high initial capital costs and the fast growth and not making a lot of money in the early days without the use of venture capital. And so the reason that we invest in this space is to go back the next one of these iconic companies, and it's a high risk, high reward space. I mean, typically at our fund, each fund will make 25 investments, and you're hoping you get one of those large outcomes. If you get 2 or 3, then you're a world-class fund and investor. But typically, if you can get one, when I was at Ignition, for example, we were one of the largest investors in DocuSign. DocuSign was a 12-year journey. That business went, almost ran out of cash 2 or 3 times. Some of the best investors and venture capitalists in the world sold their shares early. The folks at Ignition ended up sticking with that opportunity, and now, I can't remember the last time I signed something on a piece of paper. In fact, it annoys me if I have to do it. But there's examples in that end in terms of enterprise software, and then there's take a look at the auto industry, for example. Tesla's market cap is greater than Toyota, Volkswagen, GM, Daimler, and Ford combined. And whether that's warranted or not, it's just mind-blowing to think about how these companies can radically transform industries. And so that's the broad overview of why we do what we do. And really the value comes from doing 3 things well in the venture world. One is sourcing. Finding these opportunities is not easy. I mean, oftentimes it's a group of 5 people, 5 to 10 to 20 people in a house. If you're familiar with the Seattle area and in Capitol Hill with no online presence, how do you go about finding these sort of opportunities? Information is very, very, very difficult to acquire. So the first thing you got to do is put yourself in a position to see these opportunities when they're just getting off the ground, or whether it's 2 or 3 smart folks spinning out of Amazon and Microsoft and getting going. How do you make sure you're the person that hears about it? That's the first thing, sourcing. The second thing is picking. We'll typically see about 1,000 opportunities every year, and we'll end up investing in 10. And so you have to have the right due diligence process to figure out, hey, which are the right 10 out of the 1,000 that are going to potentially have the same impact of a Tesla, Amazon, Microsoft if you're lucky and things go the right way. And then lastly is shepherding. Typically post-investment, we're on a company's board for on average 8 years, which is longer than the average US marriage. And so we are really getting married to the founders and the companies that we back. And great venture capitalists, you want to be the first call, obviously when times are good, but particularly when times are not good. So there's a high level of trust that is built with the founders and the other investors, because you're all on the boat together. And it can be stressful at times because it's once you stop growing in the venture industry, you're not dead, but you kind of are. And really these companies are growing 3x every year for the first 3 years and then doubling from there on after. And that's what world-class growth and scale looks like. And so the hiring ramp is quite incredible. And that's what the best CEOs are quite good at, is hiring talent. And if you can do that well and invest in great companies, then historical data shows that venture as an asset class has outperformed the S&P by over 2x over the past 5, 10, 15, and 25-year periods. And that's the top quartile of venture capital. And so having folks like Parcion who have your back and can develop relationships with the right venture capitalists that they can go and find these opportunities is super valuable, because it's tough to get access to many of the funds. We were lucky to develop the relationship given the local geographical proximity. But if you have folks like Parcion out there vetting the right opportunities, that's a big needle mover. And so, and there's other tax incentives. There's a qualified small business tax, which I won't get into today, and a few others that the Parcion team can help you understand. But really the big thing about venture is trying to change the world with using technology, and it's weird to think about that when you meet 2 or 3 people come in the office and they just have an idea and a pitch deck, but that's how it all starts. So I'll pass it back to Terry.
Yeah, thank you. Good stuff. Thanks for sharing that. One of the takeaways that I take from that for sure is more than maybe the other 2 gentlemen and asset classes we're talking about, venture capital is truly, all of these, you should have a long-term horizon. Venture capital for sure, not only from the illiquidity, but that's just the way it works, and the growth opportunity. So thank you for that. But I also agree, because the upside is significant. And at least on this first round, last but not least, Zach, I appreciate you being here, and lots to talk about in your space. And I would say, there's real estate in itself, and then there's the opportunity zone discussion. Let's maybe, you can take it wherever you want, but I think just real estate in general, obviously the opportunity zone highlights an even increased opportunity, so to speak, from a tax standpoint. But at the end of the day, we're trying to make money out of it. It's got to be the right investment. So talk about how you see or how investors should kind of approach and view the space, and what makes it valuable to them.
Sure. And without sounding like too much of a broken record, I want to reiterate Cameron and Chris's comments about our gratitude and appreciation for the opportunity to participate with all of you this morning. We at Griffin Capital, we've been developing and investing in real estate for close to 30 years now, completed close to $30 billion in total transactions. And, as we sort of think about the market and, reflect on our partnership with you at Parcion, again, it's a journey, and there's a lot of twists and turns along the way that we have to be thinking about. And, echo all of your comments relative to the opportunity zone set, and on a more macro level, the real estate market in general. I think you said something that merits repeating. And while the tax benefits of the qualified opportunity zone legislation are very interesting and very important to keep in mind from a taxation perspective. At the end of the day, it's still a real estate trade, and the real estate has to underwrite, and you have to be able to make money on those assets themselves without the considerations taken in mind from a tax perspective. So, with our DNA as a firm really being at the core a real estate development / investor shop, we take that value proposition very seriously and go to great lengths to make sure that we are investing and underwriting despite the tax legislation in a way that we can actually pencil and make money on the assets themselves. So, just to kind of take a couple steps back, as I think about the real estate market today, I think on a macro level relative to this panel, if traditional investments like stocks and bonds were doing their job,
I think we got you frozen there, Zach. Probably going to be the most important point of the entire episode. You know what? While we get you back, apologize for that, everybody. We're going to go to the next question, and I promise we'll come back if you can hear me, Zach, and get the internet figured out. But Cameron, let's go back to you and take a look at kind of forward-looking 5 or 10 years. Your space. At the end of the day, it's a good idea and good management, good operations, but it's also a space that's been evolving quickly. So whether it's from kind of an industry focus or just how you see technology enhancing your space as far as from a growth rate, how do you see the venture capital space evolving in, say, the next 5 or 10 years?
Yeah, there's been a couple really big shifts that have occurred over the past 5 or 10, and that'll shape what's to come. The first one is the cloud computing has really changed everything, on-demand data storage and compute. And the second thing is there's been a massive dearth of capital that have come in this industry. And so I'll talk about the first one. First thing first, cloud computing. What does that really mean? So when companies were started, 15, 20 years ago, in order to get going, they had to buy physical racks, physical servers to do their compute and store their data. And so that was a big hurdle to starting a company. I got together with one of the founders of Isilon Systems, which went public and sold to EMC for $2.25 billion here in the Pacific Northwest. And he was telling me they moved into a building, and on the top floor was all their servers to power their company and to power their offering. And the structural engineer of the building came to them and said, this building is literally about to collapse. You need to get all these servers out of here. And so they had to quickly get everyone out, move all the servers. And these are just problems that companies starting today don't have to deal with. You can go sign up on AWS, which is ran by Amazon, Azure, which is run by Microsoft, and build a company within hours, and build your software, store your data, and run compute. And so what this means is there's just way more companies being founded today. People are moving quickly. They're coming up with ideas faster. They're executing faster because their data is stored in the cloud. It's way easier to run. What you folks probably heard of, artificial intelligence or machine learning applications. And so the companies it's fueling this next generation of growth. So that's number one. And because of this, number two is happening, which means there's way more capital coming into this space. SoftBank announced $100 billion vision funds. Hedge funds like Tiger Global, Co2, P27 are announcing big venture initiatives, and they have a ton of capital to pull from. And a lot of that really affects the later stages of venture investing. I mean, we're starting early, but when these companies are raising their Series C, D, E, 50 to $200 million rounds, there's more private capital available. So companies are staying private for longer, and that's slowly starting to trickle down. The traditional funds, Excel, Sequoia, Andreessen, Lightspeed, are all raising much larger funds to help, so they don't get shut out by these large these large hedge funds coming into the market. And so because of those two massive shifts that have occurred historically, cloud computing, making it easier to start a company, and way more capital, this means that the next 5 to 10 years, venture firms will really have to be differentiated. I mean, the power dynamics have shifted from the capital providers, which has been the case over the past 20 to 30 years, to the founders, which is a great thing. I mean, the power should be with the founders to choose who they want to work with. And that's why being differentiated and not just being a capital source really matters. And so for us, how we differentiate, for example, is we're pretty focused on a particular region, and that's the Pacific Northwest. And we have our reasons why we think the Pacific Northwest is the best place to be investing in primarily B2B, business-to-business software, given you have the two largest B2B software companies, Amazon and Microsoft here, and you have a bunch of these second headquarters via Salesforce acquiring Tableau. Uber's got a big office, Facebook, Snapchat, every major Google, every major technology has a presence in this ecosystem. And because of that, you're seeing an unprecedented number of companies spinning out. So, for example, we meet these companies, we say, hey, given you're local, we can help with your talent networks. Typically, when we meet these companies, like I said, there are a few people, they have a product, it's in market, they have customers paying for it, and now it's time to really build out the team and scale. And so that's one way we add value is through talent. And so I'm using that as an example to say, as a venture firm, you have to know who is the true MVP, and that's the founder, and you have to understand that your job is to provide them resources to go win. And if you have any sort of ego or think the founder should be lucky to work with me, then you've already lost, and you're not going to be able to win in this super competitive world that venture capital is becoming.
Got it. Thank you for that. And yeah, we're excited to finally be able to have access. Here we live in this arguably one of the most, if not the most talent-rich environment for innovation and whatnot. And in my 28 years, it's just been the last couple where I've actually had access to help my clients invest in that. So I appreciate Fuse giving me a source for that access. And while we'll keep working to get Zach back here, Zach, can you hear me? Not quite there yet. I'm going to go, Chris, with that same question. It's the hardest question for you, in my opinion, because where crypto goes, digital assets go in the next 5 to 10 years is, regulatory issues, technological issues, ecological issues. There's just so much that's going on there. So just give us the answer and we'll all be good.
Yeah, no, I think you hit the nail on the head. And I might even spin those too. I think there are technological opportunities, right? And there's ecological opportunities. And I saw there's a question around ESG as well. I can touch a little bit on that. But I think the interesting thing from, between myself, Cameron, and Zach, right? Like the industry that I'm representing, it's 5 years is about half of its life cycle. So this was launched in 2008. 5 years is almost a lifetime compared to 5 years in venture capital and real estate. But I do think there's a lot of overlap between my industry and Cameron's. We're seeing a ton of growth in venture capital. So I think that's bucket number one. Then we're also just seeing community growth. So think of it from a developer standpoint. So the talent that's coming in, at such a premium, but also, the level of expertise that's needed and also the dedication to the space is really astonishing right now. The third piece I would say is, I'll call it kind of like a reduction of entry risk. And I'll talk about, myself representing Fidelity, I think is one, kind of feather in the cap of Bitcoin and digital assets. And you have a multi-decade, family run, very conservative private company that decided 6 years ago to start mining Bitcoin. That's kind of a testament to where we are in this space, but also the upside that's still represented. So if we think about, kind of that first bucket where, it overlaps with venture capital, we've seen, somewhat astonishing numbers around the amount of investment in the space. So I think 2020, we were slightly over 2 billion for the year, and it was, a little more than 300 deals. That's obviously what's reported. I'm sure there's, potentially even more. And then, the start of this year, called a little over half of the year, we've already exceeded the amount of investment in the space. And so what they're doing is, teams coming forward and saying, I'm starting to understand the space. I'm starting to see some of the upside, and not even just Bitcoin, potentially a broader array of assets. Could we support, the projects and the teams that are now growing and building development towards the space? So it's a massive upside there, but also that's been a huge change from 5 years ago. So what's happened in 5 years? A lot. I mean, 5 years ago, the price was probably around $1,000 or, maybe a bit less than that. So, there alone, you've already seen a 50x just on the price of Bitcoin itself. Most of the assets today that people might be talking about and maybe are getting excited, they didn't even exist. So, take that with a grain of salt. Things that have been around for 2-3 years, obviously I would caution people to, do their diligence, really understand that. And that goes back to the second bucket with developers. So you're seeing these teams come together, and how do they attract talent to have this, very clear thesis around building an asset or another application on Bitcoin or whatever it might be? How do you attract talent from the Facebooks, the Amazons, the Googles of the world that have more money than you can imagine? But if you have this great idea, you have to somehow get that talent into the space. And I think we're very lucky right now that we're seeing people from a personal standpoint believe in kind of the broader thesis of digital assets. And they say, all right, whether it's pay cut or they're able to secure a premium in pay, they're moving, kind of their talents to the crypto space broadly. The last piece that I mentioned was kind of that risk of entry, or, kind of the reduction of entry risk. And I think that's, going back 5 years ago, people were saying, Coinbase is relatively a new company. That maybe was the first place that people purchased Bitcoin. Before that, it was peer-to-peer or was unregulated exchanges. Now you're seeing, the likes of Fidelity, Bank of New York Mellon. You're seeing Coinbase go public with 68 million users. I think the on-ramps that are now available are substantially better, hopefully a little bit more palatable. And I think, just quite candidly, like the role that I represent is really to work with teams like yours, Terry, where, we're working with institutional allocators and teams to help understand the space and then bring a solution, to their clients. So you have, a number of clients that raise their hand and they have an expression of interest for a 1% allocation, and then they say, how do I actually go about doing that? And so hopefully Fidelity and others are kind of bringing that to the fold to say, hey, this is now available and it's not quite as scary of a space as it might have been. The last part of the question, it's a little bit harder. The next 5 to 10 years, I think there's, massive upside. I think we will continue to see, price go up. I'm not going to put a price prediction out there because I guarantee I'll be wrong. But I do think we'll see the infrastructure continue to build, and you'll see more piping come together. So access points, whether it's a Bitcoin ETF or, other assets that materialize and create, call it applications and layers on top of the protocols. It'll make the user experience more available, more secure, and ultimately, a better experience overall. So I think there's opportunity to benefit financially from that, but also there is, things that people experience in their day-to-day lives that will be very, very impressive. So maybe I'll pause there. I don't know if we want to go back to any questions there.
Yeah, you brought up lots of great points. And so I think the next question, and back at you, Chris, is probably unfair. But if you had to choose, what is the biggest challenge going forward? And that's where it creates opportunities, like, right? When there's lots of challenges, that's why we know that as those get solved, the price can still go up. But what would you point to as, one of, if not the biggest challenge right now?
I think regulation is, I don't want to say it's the easy answer, but I do think it is probably the right answer. It's also, it's where we are right now. We're 12 years into Bitcoin. We're maybe, 5-6 years into some of the other assets that exist. And I think there isn't a clear framework for investor protection. It's materializing, it's coming about, but how do you regulate, 50 global exchanges where some are regulated, by local, government agencies, and then others aren't? How do you come up with kind of a global market surveillance for a 24/7 market, things like that? It's, we're dealing with, I think, pieces of markets that we haven't seen before. And so it creates new opportunities to create a framework. But I think the challenge we're going through from our seat and from Fidelity, I know that we're very strong proponents of making sure that regulation comes forward, but we want to make sure it comes forward with an educated, lens. And so we saw that recently with the infrastructure bill. there's basically two proposals, and the way that crypto was handled in one versus the other was dramatically different. In our eyes, it was basically one was kind of stifling innovation and the other one was allowing for more of a free market and saying, hey, let's allow, these innovators, these young teams that are looking at new ideas and trying to break barriers and say, let's let them compete and let's see if things can come at us, but let's put some guardrails around it. Whereas if we just, stifle innovation with very strict regulation that fits into the framework of the old traditional system, I think it's disadvantageous. And again, just taking a US lens, you might see a lot of that move outside of the US. And so, you see that across, I'm East Coast based, but a lot of folks here I would imagine are majority West Coast. And you see there's differences between the two coasts. I think you'll see that just globally as well. If you start to see certain countries disallow innovation, this is a global environment and you can just really, if you have access to the internet, you have access to this market. So, I think that'll be seen. A very small example of that would be El Salvador with their Bitcoin Beach. They basically welcomed the innovation. They've welcomed the opportunity to, say course correct a little bit around their monetary system and allowing Bitcoin to be legal tender. So we'll see how all this plays out. I think, the short answer would be regulation. I think it's welcomed if it's done with an educational, kind of lens, if you will.
Perfect. Yeah, great answer. It'll be interesting to watch how that evolves, especially with all of these central banks at least giving lip service to their own digital currencies and how that competes and whatnot. That's part of the regulatory environment. So Cameron, same question to you. I mean, there's again, always lots of challenges, a lot of challenges to any business starting up, right? But is there any general overriding theme to a big challenge in the venture capital space overall?
Yeah, I think the biggest thing, and this has always been a challenge, but it's becoming more acute now, is hiring and retaining talent. Chris alluded to this earlier, but I was in an event a couple of weeks ago where a founder was that I know, that we're not investors in, but I know him. I consider him a friend. He was, he was pretty down, and I walked up to him and said, what's wrong? And he said, we just lost our best software engineer. And when you're a team of 10 or 20, you lose your best software engineer, that's a big hit. And he said, one of the big companies, Square, offered him $650K a year plus a bunch of stock options to come work for them. And this is a company with a talented CEO and a mission-driven company. And it's just tough. These challenges like that are really tough because large companies will pay a lot for talented software engineers. So as we look to invest in the venture capital space, that's one of the number one things that we underwrite is the team abilities to hire and retain talented engineers. And the retaining is harder to diligence. The hiring, we have a couple techniques. We'll send them talented candidates. We'll send them a talented CTO or a talented VP of sales or a talented head of customer success or VP of marketing. And we'll see how the CEO or whoever's hiring, how quickly they react, how quickly they jump all over that, just because you have to be quick in this world. And a lot of times these software engineers, they want to work for people that people that are inspirational, whether it's the CTO that they've worked with in the past or products that are mission oriented, and they really buy into the mission. And so it's the biggest challenge has always, and will remain to be hiring people. But these entrepreneurs are extremely resourceful. I mean, they're just incredible people. And I'll give you an example. When I was at Ignition, we invested in this company based in Calgary, Canada, called Cement. And it was founded by a CEO, an entrepreneur named Hanif Josagani. He was a Iranian immigrant. He spent 14 years on a refugee camp on the border of Iran and Iraq during the revolution in Iran. Well, he comes over to Canada with his mom, and he remembers being a kid and his mom getting hounded by debt collectors. They just never would leave her alone and were blowing up her phone. And so 20 years later, after he got some experience in the real world, he started a company to help large enterprises better engage with their at-risk customers. Typically right now, you don't pay your cell phone bill 5, 10, 30 days, you get passed off to a debt collection agency and they start hammering you. And that was the experience that he wanted to stop. So he had this deep pain inside of him from a memory that he had as a kid, and he set out to solve it. And so when an entrepreneur has that sort of a pain or vision, people and talent will gravitate around that. And so it's harder. We have techniques to underwrite it as a venture firm, but that's why the biggest thing in venture is when you meet people like Hanif, you back them because you know that they're going to find a way to get it done. They're going to run through a brick wall and they're going to be aggressive on hiring the best people. Just given it's that pain of seeing his mom go through that means he's not going to he's not going to lose. And maybe something happens in the industry, you never know. But so that's the biggest way that we address that challenge is if we're excited, then the people that work with him will be excited. The culture that they've set at the business is important. A lot of companies, given they're so focused on growth, culture becomes tougher or they just don't think about it early on. So we help them set that culture early on, and that can really help keep talented engineers. And it's tough right now because of COVID, because engineers can live anywhere and work for whatever company.
Right.
And so building that culture is harder. So you gotta get pretty creative.
Right. So thank you for that. And we've got Zach back. Zach, I feel your pain right now. I think everybody on this call has been there in the last, year and a half or whatever. So welcome back.
Thank you. Apologies. Yeah, total computer malfunction and shutdown there. So my sincere apologies.
What would a webinar be without something like that in this day and age? A number of people obviously have tuned in to this in part to find out about the real estate space, and there's a lot going on there. And we can maybe combine a couple of these questions into one. But just talk about the landscape right now, including why is this an important part of a portfolio, and where do you see things going in the next 5 or 10 years from a sector standpoint?
Sure, it's a great question, Terry. And I think as we look at the world right now, it's changed a lot over the past, call it 5 or 7 years. And is changing even more so with COVID and all of the challenges that has presented. I think the one issue everyone's trying to solve for right now is income. And when you think about a new regime in office and uncertainty around what taxation might look like going forwards, real estate as an asset type has had a tendency to generate tax advantaged income, which really plays nicely into the theme of our panel today, right? It's alternative sources of gaining exposure to different asset types out there. And real estate is certainly no exception. Historically, it's generated very tax efficient income. And what you're investing in when you invest in core real estate is contractual revenues that are being generated from structure, whether it's a multifamily building where rents are on an annual contract, or an industrial asset where those rents are typically 5 to 7 year duration in nature. But my point is, you have the opportunity to plug into a pretty predictable stream of income, barring any weird idiosyncratic market events from happening. It's an interesting time right now. 46% of all institutional investors polled came out and said that they plan to increase their exposure to commercial real estate over the next 2 years. So we're seeing tremendous growth within the space. And I'll just single out the concept of life sciences, which is really the intersection of biology and technology. This is a white hot asset type, which is woefully underdeveloped right now. And we're seeing tens of millions of square feet come online right now to sort of help support this new growing trend within the market. And it's an asset class that we're very, very bullish on. So we're excited. We think the future is going to cater to managers that are active in nature, that have the ability to be flexible and pivot into areas that are opportunistic in nature, and certainly taking advantage of areas that have been predictable sort of hitters of singles and doubles, if you will, to use a baseball analogy. Multifamily has always proven to be very resilient during good times and bad. It's typically the first check that people write every month is their housing facilities and their housing costs. And certainly opportunistic more in the life sciences sector. And as you think about e-commerce, I'm sure everyone on the line today will attest to the fact that Amazon boxes show up pretty regularly when you press the buy now button. And when you think about the actual cost for every $1 billion in e-commerce sales, the marketplace needs to deliver 1.25 million square feet of industrial space. So e-commerce ties very nicely to the whole industrial story in the sense that that is an area of the market that we continue to invest a lot of dollars along with multifamily in an opportunistic way, just given the way in which us as consumers conduct business on a day-to-day basis. So I'll pause there, Terry, and turn it back to you.
Yeah, that's great. And to catch up on maybe the last question, when you joined us back, what do you see as the biggest challenge looking forward? Is it economic? Is it potentially regulatory? Is it tax? What would you characterize as the biggest challenge?
Yeah, sure. I think it's all of those things. I think it's a moving target, right? We don't know what the new tax regime is going to look like when the office that's currently in pursues what it is that they're trying to do. It's something that we're paying very close attention to. It's something that again is variable in nature. We don't know what it's going to look like yet. Certainly the pockets within the real estate market, we don't really know what's going to happen with the office sector. We have been paring back that allocation for some time now. Specifically the multifamily portfolio and our OpZone funds are not in any way, shape, or form impacted by the office market, but at a firm level, it's something that we certainly pay a lot of attention to and think about on a broader scale. When people go back to work, whether that's this year or whether that's next year, what is that floor plan going to look like? How much tenant improvement costs are going to be necessary to sort of build out the bullpens in areas where there's, sort of adjoined working space? Those are a lot of questions that are still unanswered at this time. And, it's something that we're uncertain of, but something that we continue to pay close attention to and, absorb any research that's out there. But at the end of the day, this whole COVID-19 virus has changed many things in our lives, and workspace as we know it is certainly no exception. So that's something that's definitely high on our radar.
Right. And I want to touch on, we get a question from one of the attendees out there. I think it's really important, and maybe just a quick response on each of your view on how, certainly with a number of our clients and certainly with a lot of the younger generation, and thankfully environmental, social, and governance screens and strategies are becoming more important. And I've got thoughts as they relate to each one of your sectors, but I'm going to, in reverse order and go back, I'm going to start with you, Zach. And, obviously in opportunity zones that addresses some of that from a social impact, and that's policy driven. But how do you view, or how does Griffin Capital kind of view an ESG approach or responsibility?
It's a great question, Terry. I'll go quickly through my thoughts here. So one, I mean, the concept of an opportunity zone is really predicated on the idea of regentrifying areas that are woefully underdeveloped or haven't been regentrified in some time, up and coming areas. And when you think about where some of these areas are, they might surprise you. It's pockets like Brooklyn, it's pockets in the country like Nashville, Austin, Texas, even places in my home state of Arizona. They're great areas, but when you think about the duration of the tax code and when these things were actually designated, some of these areas have actually already started to be developed already. So we love the feel-good aspect of affordable housing and putting good places to live in the path of future job growth. I mean, this is really what our country was built on is opportunity, and we think that giving folks good places to live at a reasonable cost is a very key element to that whole paradigm shift. At the real estate level, I think ESG really resonates through with everything that we do on, within the past several years, looking back and certainly forwards, is everything from building socially responsible structures with low voltage lighting, all the way to the way that we insulate certain structures that we're developing, and everything in between. It's making sure that we're being good stewards of our environment and making sure that as we construct these buildings, we're doing so in a way that is sustainable and in a way that is not going to be detrimental to our planet in any way that it already has done damage.
Right, helpful. And Cameron, to you, I've always thought that innovators and wealth creators will solve kind of social and environmental issues way faster than government or policy many times. And so can you talk about how you view kind of the ESG strategies in space, and if there's an overlay in your selection, or is that just innovation will generally solve for that and to meet the demand?
Yeah, I'd say there's two aspects of this that we pay close attention to. It's what our companies do, and are the companies that we are investing in having some sort of a positive or negative impact on the world. And then the second is, what are the companies that we're investing in and our own company, what do we look like from an employee standpoint? And so we're tracking this stuff internally with related to Fuse in terms of how many folks from diverse backgrounds do we have? And then every company that we invest in, and we're now starting to actually institute ESG reporting in terms of, okay, how many people have you hired from underrepresented groups, women, minorities, and that's something that a lot of funds are paying more attention to, a lot of limited partners are paying more attention to, and the best companies are paying attention to this. And the tough part for the companies, and it's not tough, it's an opportunity, I think. But when you're a team of 10 and you're expected to go to 30 in 6 months and then to 60 within a year, there's a lot of pressure to hire. And so one of the things that we do when we come on board is we connect them to the right sources of diverse talent. For example, we work with a couple of different organizations, one that has great pipelines into female engineers. And if you post a job on their candidate website, you get a much higher response rate and applicant rate from female engineers. Another one is a firm that's working a lot with getting Black people into sales roles. And so they've identified that you don't have to go to, if you go to school for 4 years, or even if you don't, they can teach you a lot of the necessary skills to become a talented SDR and entry-level sales exec and work your way up from there. And so salespeople, technical talent, that's really hard to solve for. And when we can connect our companies to these sort of sourcing pipelines that have been built, it helps them create a diverse team faster, and then we report on that and are planning to start reporting on that over the next year to our limited partners.
Thank you. Yeah, it's interesting. And we're running out of time, Chris. So I give you the most loaded question in the crypto space right now, and then I limit you. I'm just kidding, but top of mind, obviously a lot of the folks who are very involved and interested in watching the crypto space and Bitcoin in particular are also sensitive to the environmental impact that the mining creates and whatnot. So what's the space in your perspective? What's it doing to address that?
Yeah, and this could be an entire presentation on its own, but I'll try to go through each relatively quickly. But the environmental one, I would kind of start with a statement of, if you think Bitcoin has value as a global monetary system, then okay, electricity, energy is an input that's necessary. And so it's capital intensive input to basically allow for the security of the network. That being said, obviously it's a major headline right now. And one of the reasons I think is somewhat around misinformation, but also it is capital intensive, it's energy intensive on what's going in to go and kind of produce these miners. So the one caveat I would say is most people I think don't realize the forward thinking and kind of the initiatives that are around renewable and kind of sustainable energy that's being used. I think if I'm not mistaken, it's the highest percentage of sustainable energy that's been used across either a country or an industry, but it's not to say that Bitcoin isn't still using a substantial amount of energy. So I think the E is in itself one debate, but I think you can't decouple it from the S and the G, right? So if you have social and governance, and you have this idea, if you're thinking about ESG, I think environmental gets a very heavy weight, but at the end of the day, I think they are equal weighted. And so if you think of from a social perspective, I mean, to me, this is a no-brainer. You have a global monetary system that can be accessed by the internet. So you're essentially, it's not controlled by a government. You're allowing people that are either unbanked or are under oppressive regimes to now have another option. They have a way out. So I think from a social perspective, you can make a very strong case. And then from a governance perspective, I mean, it's a decentralized network. Nobody controls it. There's no central authority at the end of the day. So it is, it's a bit of a weighting mechanism. I understand, there is no question energy is being used, but I think, if you look at the broader scale of what Bitcoin could represent, you might be able to make the case that, the energy that's being input into this is worth the output for the world. So I'll pause there. But yeah.
No, that's a great answer, and it's top of mind. So I appreciate all of the time that you gentlemen have given us, and I would encourage. I know we didn't get to a couple questions. We'll make sure to reach out and get your questions answered. And for those of you who are watching this on the recording, email us. We're happy to also put you in touch with our panelists, but we'd love to hear from you and appreciate you spending some time and learning about this important alternative investment space. So with that, thanks again. Thanks to my panelists. And if we're here if you need us, and we'll look forward to talking to you soon. Thanks for joining.